Hi everyone, how are you? It's Leah Constable with the Mortgage Center. I really wanted to help you understand a little bit of terminology, but more importantly, for those of you who are looking to refinance your home down to less than 20% equity in it, or if you're looking to purchase a home putting less than 20% down, I really want to help you visualize exactly how your money's being divided within your home, because most of you are extremely wrong in how you think your money's divided, and I don't like to have any surprises with any of my clients. I like them to fully understand their mortgage. So what I want to do is first show you guys just a bit of terminology you've probably heard of, and I'm going to talk about high ratio and conventional. So with high ratio loans, this is the vast majority of you. You have a high ratio loan, and what this means is simply that you're putting less than 20% down as a down payment on a purchase, or if you're refinancing, you're refining to where you have less than 20% equity in your home. Now, on the flip side, a conventional mortgage simply means that you're putting 20% or more down payment on a home, or if you're refinancing, simply that you're leaving at least 20% equity in there. So as with all of my presentations, I like to use actual real live examples. So for this example, what I want to use is a $400,000 property value. Now it's important to distinct, just as a side note, that a purchase price of $400,000 is not necessarily the property value. Just because you're purchasing it for $400,000 doesn't mean that that's what the bank will lend you on. The bank is more concerned with the property value, and for this example, we're going to use $400,000. So this is how your pie chart looks to most of you when you are buying a mortgage, or rather this is how you're visualizing your pie chart, but this isn't actually how it looks. So on a $400,000 place, you're visualizing that you're putting 5% down, and in this example that would be $20,000, and you're kind of visualizing that you're putting it away into some sort of little savings account, or that it's your banked equity and you can tap into that when you want. And then, of course, the remaining 95% is simply what you owe for your mortgage, but that could not be further from the truth. If you put less than 20% down, then you must pay for mortgage insurance fees. Now, what is mortgage insurance fees? Well, you may have also heard of something called CMHC fees or Genworth fees. This is a government-mandated insurance, and it's important to note that this is insurance that covers the banks. It does not cover you. And the reason that this is so important and crucial that we pay for this insurance is because back when in 2009 and 2010, when the whole economy kind of collapsed all across the world, Canada was one of the top surviving countries. Our banks didn't go out of business. We had minimal foreclosures. We really did quite well through the recession. So part of that reason on why we were able to stand on our own 2 feet, as in contrast to the US, who completely fell over onto their knees, is because of the CMHC and Genworth fees. So what this does is, if you purchase a home from the bank and the bank lends you money for the mortgage, if you should default on that loan and go into foreclosure, when the bank takes your home and resells it, if there's a shortfall on how much they lent you to how much they've actually received back, then this insurance will recover that difference. That's what this insurance does, okay? So that's a really quick explanation, but definitely check out my other videos. I do go into more depth as to mortgage insurance that covers you and mortgage insurance that covers the banks. But that's what happens in a high ratio loan. So it's very important that we maintain CMHC and Genworth fees, and it is a government mandate that you have to pay it. So this is actually how your pie chart looks like. Now, it's this 5% up here that really has changed. Your 95% mortgage is still the same. You're going to have a mortgage of about $380,000, but it's this insurance number that people always forget about. Now, for this example, I'm going to use a 35-year amortization. I find that most people, because especially in BC, prices are quite inflated, and so people want to have the best quality of living that they can afford, which means they typically need to take a 35-year amortization. The reason that I make note of this is if you're going to have a 35-year amortization as opposed to a 25-year amortization, there is a bit more of a premium for getting that, but it's not that much more that I wouldn't encourage you to take it. So in this example, your equity is actually only about $8,000, and this insurance is actually $12,000. Now, when do you pay for this insurance? Is this something you have to pay out of pocket, or how does this work? No, what the banks actually let you do is wrap that up into your mortgage, and it's the only fees that you can wrap up into your mortgage when you have 5% down, okay? So Your full mortgage amount on this $400,000 purchase is actually $391,000 and your equity is $8,000. So the part that I really want to make sure that you understand is that when you put 5% down, you don't have 5% stashed away in some little kiddie pool. This is all that you have is $8,000. Now again though, I'm not wanting to tell you this so that you get into an outrage and you go, oh, why do I have to pay this? I don't understand. And I also don't want you to take the point of view where, oh, well, then that's simple. I'm just going to do whatever I can to avoid CMHC fees, which is saving up more than 20%. In such an inflated market, most people don't have the luxury of being able to save up 20%. So like I mentioned in the beginning, this is for the vast majority of you. You're going to be a high ratio loan, and that's just how people start out, especially on their first purchase. So I don't want you to get angry. I just simply want you to understand how your money is being divided. So I'm sure that you have different questions about this. So comment on this video or email me right now before you forget, and make sure that you send me your contact info so that I can actually get back to you. If you contact me today, I can normally get back to you today. Worst case scenario, I'll get back to you the next day. It just depends on what time of day you actually get a hold of me. So let me know if you have any questions. But for those of you who are in a situation where you have the luxury of being able to actually already have savings of quite a substantial amount, and you're just trying to determine, oh, should I put 20% down or should I put less down? Or if you're looking to refinance your home and you're going, well, should I refi to 20 or less? I definitely encourage you to put the full 20% down payment down, or if you're refining, don't refi down to less than 20% equity in your home. If you leave 20% in, this is called a conventional mortgage, and it's much simpler pie chart to show you, and it will save you money. So as you can see, the pie chart is really simple. 20% down, which would be $80,000, and then $320,000 is your mortgage. No insurance fees, okay? On the flip side, though, you have to understand there will be an appraisal needed, and this is just across the board. Every bank is going to want an appraisal if your mortgage is not insured. The reason for this is, like I mentioned before, just because you're paying $400,000 doesn't mean that the property is worth $400,000, and that property is the bank's collateral. So they want to make sure that it's worth what you're paying for it and that they're lending you based on the property value, not on the purchase price. Now, an appraisal will typically run you anywhere from $250,000 to $450,000, depending on the size of the house, who you use, and how quickly you need it. But you can always contact me if you need some references as to who to use. You also have to make sure that the appraiser is on the lender's approved appraiser list. Okay. So if you want any additional information on mortgage insurance, anything really mortgage related, definitely go to my website or to my YouTube channel. Unless you're already there, then just keep surfing around. If there's a mortgage topic there that you do not see, then let me know. I want to make as many videos as I can to help everyone out there. So yeah, just let me know about that. My contact info, if you are looking to get a hold of me, is right on the page here for you, Leah Koss with the Mortgage Center. You can apply to me online if you want to get started today on getting a mortgage, or if you want to get a pre-approved for a mortgage, I can actually do that right over the phone. It's a preliminary pre-approval, but it will give you some numbers to start working with. So again, my name's Leah Koss. I'm with the Mortgage Center. Thank you so much for watching this video. I hope it's been helpful. If you have any questions, let me know. Otherwise, I really hope to be talking to you soon. Thanks so much.